Is that coming through okay, Joe?
Yeah, I can see that.
So this is just a thing really to say that we'll have a range of people that are here today. Some might be actively in the market and interested in selling a business in the next 12 months. And others might be at the other end of the spectrum, which is just, you know what, this is something that I probably should be giving more attention, and I've not really done so far. You might have set up a business out of passion, and the thought of selling it is something that you've never really been able to get a focus on. But it's fair to say that not necessarily sell your business, but exit your business is something that you will, fortunately or unfortunately, have to do one day. And the key is to try and make that on your terms. So there's lots of nuances to exiting your business and different ways of doing it, which Joe's going to walk through today. But essentially, I put it into 3 categories. You're either going to do it on death, as horrible as it sounds, or during life to family members. You know, the business gets passed down through the generations. You're going to sell it for a capital sum, which I think is the thing that most people aspire to do, I guess, in order to, as Joe will talk about today, really realise the value that you've built in the business. Or thirdly, hopefully not, but wind the business up. And that could be as a result of the business failing, although that might be too strong a word. You know, you just not wanting to do it anymore, not wanting the emotional stress, which is completely understandable. Or just because you've built up an amount of capital that you want to get out of the business, and maybe it's not actually something that there's a market for selling that business. So the middle one is obviously what we're going to be mainly focused on today, and there's different ways of finding possible purchasers and different types of deals, whether it's a full exit or partial exit, and the type of entity and people that acquire you. And how that looks on the other side of the deal is also a really key factor. You know, this is not just about, although we're talking about value today, this is not just about how much cash can you realise. It's what you're going to be doing on the other side, what's going to be your involvement in that business or another business. We have actually created a couple of things that free resources that might help just to get you clearer on this. So we've got like an owner's sellability, an owner's readiness quiz, which is just for you to answer a few questions. Probably takes 10-15 minutes just to think about how ready you are psychologically for exiting a business. And it'll talk about things like your life plan, you know, some of the stuff that we talk passionately about on the podcast with Adam, the financial planner. How ready you are emotionally to part ways with the business, where it fits in your life plan in terms of the cash that you need and what you're going to be doing next, and your role in the business or another business or that kind of thing. And then we've also got a sellability quiz, which is, again, really important about not just how valuable is your business, but how sellable is it in the first place? How attractive is it likely to be by a buyer to a buyer, and answering a number of questions that will help to ascertain that. So Joe's going to dig into some of those areas today, but it's just to say that, you know, if this is an area that you want to start paying more attention to, then reach out to MAP and let us know, because there's lots of ways that we can help you to do that. But the reason I wanted to bring Joe in today is because this is his day job. This is what he does. He does deals, and if you're interested in acquiring, exiting a business, then we partner with people like Joe, because he's got businesses that might be interested in speaking to you, and as I say, this is what he does, so there's lots of value that he can bring. So I'm going to stop sharing, and Joe, if you can start sharing your screen. I'll keep myself on for 2 reasons. One, because I might come up with questions that I ask that I think might be on the minds of the people listening and might be useful, but secondly, I can read out the questions to Joe that anybody pops in the chat or the Q&A, so that Joe can focus on his slides. I mentioned earlier, but some of you might not have been here at the start, is if there's anything you want me to ask Joe privately, i.e. on a no names basis, then just do a direct message to me in the chat, and then I'll read it out to Joe without saying your name, or I'll answer it myself, depending on the nature of it. So I think we're ready to go. Over to you, Joe.
Brilliant. Thank you, Paul. Fabulous, and thank you everyone for coming along. So what I wanted to talk about today is realizing the value in your agency, and talk a bit about the market, and what are the value drivers within agencies that kind of buyers look for, and if this is part of the journey that you want to go on. So just to introduce my business and myself a bit. So SI Partners, what do? We build value in agencies, consultancies, and tech service providers at the forefront of the digital economy. The majority of our business is what we call sort of human capital, or with a human-based businesses. So agencies are really sort of our lifeblood, and businesses of that ilk. We are a global M&A advisor. So I have colleagues and offices across the globe. We started in London about just over 20 years ago. I think it's about 21 years now, and then have spread our network and our tentacles across the globe. And we made a decision about sort of 15 years ago: do we specialize, or do we kind of generalize and stay in one market, or specialize and go globally? And we retained our specialism because we think it's what really makes you different as a sort of corporate finance advisor. But we are very active in the market. We do a deal about every 3 weeks. We've done 150 transactions overall. And I guess one of the reasons that and Paul alluded to it, why what do we bring? It's our acquirer network. So we have over 1,000 acquirers that are in our books that we know and talk to on a very regular basis. And the fact that we've done transactions with most of them, if not all of them, then kind of just allows them to answer our calls when we call them, when we phone them up. And these are just some of the deals that we've done recently. These are all in the last 2 years. Sometimes the kind of the buyers are as interesting as kind of the nature of the sellers, but we've got a very good sort of cross section here. So we've sold business to Omnicom, a lot of private equity backed groups, Publicis is in there, some newly listed groups in CI&T. So there's several social deals. We Are Social and Tag, both social businesses. They're both out in the Far East. So real breadth of people. You've got Brain Labs in there as well. So hopefully gives you a bit of a feel for us and the sort of clients that we work with in and around the digital sector and the agency sector. But I'll sort of drive straight into kind of what are the building blocks of value, and this is something that we talk to clients a lot about when people are thinking, okay, I'd like to realize some value. How do I, kind of what should I be thinking about in terms of, being able to present myself to the market and what's going to drive the most amount of value and importantly, and drive the most, the greatest options in market, because it's not just about value. As Paul said, you kind of, any deal that you do will not just be about the point that you sell today. Actually, it's going to also be about the future and, kind of you'll always have an earn out or some long-standing relationship with whoever you buy to, just because of the nature of the business is. So in 9 times out of 10, that'll be the case. So having more options and more people interested will just give you more control and choice over the future. So I think there's your offer and your clients are going to be why someone will walk through the door and come and talk to you. Your offer is clearly what you're doing, and the client is what you're doing, who you're doing it for. And I'll break these down one by one in the next set of slides. But just about every occasion that is why people will come to you to look at your business. They then look at kind of what underpins that. So who is in the management team? What systems and processes do you have? And so much of that is about, are you a proper business? Are you doing the right things? Is your business scalable? And then, that will maintain their interest. But then if you go look at the profit and the growth, this is how they'll actually value your business. So what is the profit that you're doing today? And what is the growth that you'll be able to achieve? And it's a combination of those two things that will, equate to the value. I've said profit here. People will say, well, what about revenue, Joe? So many, we hear about deals being done on revenue. I think the reality in our space is revenue is just another expression of a profit multiple. All buyers will be looking at your profitability and not just your revenue. And certainly in this climate as well, it's ever more so. So, you've got this kind of 6 pillars here, or 6 blocks, if you like. You don't need all of them. No business is perfect, but you do need to kind of have most. I'll break these down sort of one by one and just kind of walk you through them. So when I say offer, what do I mean? So it needs to be contemporary, strategic, and consultative. So contemporary is, got the digital, data and tech enabled services that your clients are demanding. Strategic is really important. So C-suite influence. So strategic is often measured by your GP per head. So this is really saying, you know, who in the client are you talking to? Are you talking to head of brand? Are you talking to the sort of executives? Are you talking to the C-suite? You know, because that will determine not only your ability to charge, but also your stickiness within that organization, and your ability to sell additional services. So the further up the food chain you are, the more desirable it is, and then the more consultative you are. And again, GP per head will kind of measure that. And so what is GP per head? So your revenue is obviously the money that your clients pay you. If we take off your direct cost, that gets you down to your gross profit per head. So your gross profit really is your ability to charge your people out at, because, you know, the next cost is your people cost. So if you're getting anything north of 100, you're in a really good place. And, you know, kind of a lot of buyers are looking at their GP per head and saying, can you match, you know, or are you far away? Because it's quite hard to pull someone's price point and pull someone's team up to their level. So it's a key metric that people always kind of come back to. Measurable outcomes has more relevance now than it's ever been. People are looking for ROI, kind of with the economy isn't in this best place. So the more you can prove that, you know, again, it goes back to that contemporary. It's what people are asking for, it's what clients are asking for. Data and tech enabled. You could put AI in there as well. Obviously, is very much zeitgeist, albeit, you know, everyone's trying to work out really what does AI mean and how do you use it in a meaningful way. But you know, you need to have that data as a pure as a part of what you're doing. I think you know, particularly in a digital agency, if you don't have data, then actually it's a real missing link. And then diversified revenue streams. I think this is less relevant it depends on the kind of nature of your business, but, you know, just different revenue streams to ensure that you know, buyers are always looking at risk. And if you're totally reliant on one revenue stream, then that can bring more risk into the equation.
Joe, could you just elaborate on the measurable outcomes?
Yeah.
Is that about the nature of, you know, like the pricing and the projects that are being delivered that are more about the outcome as opposed to selling on materials?
Yeah, so I mean, measurable outcomes is so it's, you know, there's been a shift in the market over the last 10 years, the rise of digital, if you like, and, you know, people are looking far more about how do they achieve ROI. So how do you prove ROI to a client on the spend that you're doing? And you know, the more you can prove that, the easier the sell is, the more sticky you are into the client. So I think it's very much aligned to that, and I think it's even more pertinent at the moment as we see the commoditization of digital and the, you know, kind of we're seeing creativity becoming much more part of the narrative than it has been for a while. It's always been there, but it's definitely, you know, people are looking for more creativity. So coupling that with you know, the digital you know, output allows you that measurable outcomes for clients.
Yeah, it's interesting to see this broken down as well, because you've used stickiness a few times there, and that would be like the overriding thing. I think we're talking about client retention, but these are actually the drivers of client retention, I guess, that a buyer would want to dig into a bit deeper.
Yeah, absolutely. I mean, and this is the way a buyer starts their journey is majority of it, well, they're always looking for a capability. Okay, so a buyer will go, I need this capability. Now, they either need it in a new geography because they have it in one and they don't have it in another, or it's a capability that they don't have or are relatively weak on. So, you know, the capabilities they're looking for are inherently contemporary because it's ones they don't have. So this is always going to be the start point for any buyer. And you know, and this does counter slightly to the diversified revenue streams, but buyers will always be looking generally for quite a specific capability. So they're looking for businesses that, you know, it's much better to have a business that has one discipline and has scaled to 5 million than it is to have multiple disciplines and scaled to 5 million. Because it's you know, if you're saying, well, I do, you know, a bit of performance, but I do a bit of, you know, a bit of media buying, and I also do a bit of PR and a bit of comms, and I do events. You know, actually, buyers going, well, I just want media buying, so I don't need the other elements. So, you know, creating specialism is critical as well.
And so, where does the diversified revenue streams come in then? Right, you say that contradicts that a little bit.
Yeah, I think it's just not it's remaining contemporary within the client. It's going to be different for different businesses, Paul. So I don't think it's. I think the specialism and what makes you special as an agency is really what brings people to your door. Some businesses, it's going to be relevant to diversified revenue. So if you take a media business, for example, it's going to be important that you're going to have a mix of, in this instance, different ways of monetizing the media that you have. So therefore, you're looking at your diversified revenue streams from that perspective.
Yeah. So diversified, but within a niche service. Yeah. Cool. Thank you.
No worries. So then clients. So this is the second biggest driver for a buyer, is then to look at what clients that you have. And broadly there, if you think a buyer has a strategic map, and part of that strategic map is I want to buy more, I want more clients, and I want more clients that sit within the realm of what my ambitions, what is my perfect client? Now, in majority of examples, the buyer's gonna be bigger than you, so they're going to be looking for bigger clients. Okay, so for me here, there's a big difference between national and international clients. So national brands are the ones that, if you mention WH Smiths to an American, they won't understand what you mean. But if you might mention Caterpillar, tractors and trucks, then they will understand that, right? So it's, there's definitely a step between within sort of the client hierarchy, and not only is it the size of the client, is how much does the client spend. And because client, buyers are going, well, a good client for me is someone that spends £500,000 a year plus. Okay, so they're going, right, well, in a target, how many clients do you have that look like that? Now, at £5 million of revenue, if I use that as an example, you might have 10 clients doing that, but they won't need to. But if you've got 3 or 4, then they'll go, okay, you've got some big clients that look like me that are spending in a way that kind of I want them to. Take this to extremes. You've got Accenture. Accenture's whole strategy is how many clients can I get globally that spend £500 million plus. And that's, they're just buying more and more capabilities to add in to that, to enable to facilitate greater client spend in each one of their verticals, and have client partners that just run those clients. So what does that look like? Well, obviously blue chip, to have bigger clients, then they've got to be blue chip or contemporary. What does contemporary mean? So up until about sort of 6 to 12 months ago, this was a lot about startups. There's a lot about technology businesses, and then scale ups that are coming through. So think of people like Eve Mattress, all of these Airbnb, those sort of clients. There's a slight hiatus on some of the spend in those sectors at the moment, but I don't think that's I think that's temporary. This is a rebalance. These businesses aren't going away. It's just a sort of pause in that. Other high growth sectors are finance, big, complicated, desirable. The healthcare, again, very, very high growth sector. And in fact, if you divide up, the S&P 500 or the NASDAQ, you'll see that there's only, they basically are an equal four equal parts, which is technology, healthcare, finance, and other, right? So kind of, if you're in one of those 3 sectors, then you're in a pretty good place. Sports is interesting. Sports is quite a niche sector, but actually is a kind of a vertical that you've got a limited set of buyers, but actually a good set of buyers and can command good prices for. Obviously a balanced client base. So client dominance, your single client, anything over sort of 10-15% is, clients are beginning to ask twice. If it's over 20, it's starting to get into, sort of querying, and doesn't impact your ability to sell. We saw one business this year that had a very high client concentration. We're going to sell another with a very high client concentration this year. It just limits the value and limits the buyer set. You just have you're less likely to succeed. So just need to be really cognizant of that. Even if you say, well, it's in multiple different parts of the business, they're all kind of independent of each other, you're still at risk of that one client cutting marketing spend, right? And therefore, irrespective of if you've got different clients within there, you're still kind of risky from that perspective. Predictable recurring revenue streams. So obviously SaaS streams is going to, kind of that will generate or subscription is going to generate the most amount of value because it is the most predictable and the most recurring. But there are lots of different versions of what recurring revenue looks like, and recurring I would say. So client longevity, stability of spend within a client are all, really good indicators of this, and things that we would look at, and that tracking that history. And then direct and sustained client relationships. So direct is really important. So sometimes it can be quite easy to build a business if you've got a very specialism skill by gaining your clients through other agencies. Inherently that doesn't really generate any value in the longer term, because you're not actually able to own and control that client. You're at the whim of the success and the the whim basically of that agency about whether you're their preferred supplier. So that's probably one of the most important, is having those, holding onto those client relationships directly.
A couple of things to pick up on there, Joe, before you move on. In terms of the balanced client base, like you said, no business is perfect. You don't tick all of the boxes, and there will be agencies listening today who have got a client who's eating up a sizable chunk of their revenue, and it's not an overnight thing that you can change or even want to change. If that's a client where there's a good value exchange, they might bring repeating revenues, they might be a blue chip company, they might tick a lot of boxes. I think the key is, whether you're looking at it in terms of building a business to sell for somebody else or just having a more resilient business yourself, it's a lot of the same practice, isn't it? And it's how you can take advantage of the other areas from having that bigger client. So like you said, not allowing it to consume so much of your business that if and when they go, the business falls over. Because I think that the danger is when you've got a client eating up so much of your revenue, you start to neglect other areas of the business, and you don't push as hard on sales and marketing because you've got a client continuing to spend more and more money with you. So your sales and marketing gets weak, and other areas of the business can be affected as well. And then I completely resonate with what you said about the revenue streams as different. You could define recurring revenue in different ways. I often talk about retained revenue versus repeating revenue. And you can break this down in your account. So you can come up with a definition to say, okay, retained revenue is a retained ongoing contract, but you could still have something that you class as repeat business because this client has always signed off every year, and therefore it's more repeat in nature, which is different from the project revenue that's more of a one-off hit. And you might as well get this stuff right ongoing for two reasons. One, because it's harder to go back and edit all this data later if you do go to sell your business, but also because it helps you to become more focused and more accountable for building the right type of business and the right type of revenues as well, if you're tracking it in the right way during your tenure with the business.
Oh, yeah, absolutely. Cool. See, like I say, they're the two elements that make someone walk through the door, but once they get in, these are the sort of things they want to see. So the management team is imperative. And I have seen businesses bought because of their management team, because of their CEO. People just want that person and that team inside their business. A lot more common amongst the consultancies. They are very much about the people, as well as the clients. Is what, who is there, because they are, very, very large, very well-established people businesses. So they're very keen to understand who sits beneath the founder, the CEO. And are they committed? Are they incentivized? And are they shareholders? Is it fully formed? Is it scalable? Have you got people in there that are able to sell independent? How reliant are we on one or two individuals? And if the proverbial bus comes along and wipes someone out, actually, can the business still sustain itself and kind of realign around perhaps a slightly different structure? The incentivized shareholders is incredibly important. So when buyers are looking at businesses, and by the way, I'm agnostic here, if it's a strategic buyer or a financial buyer, with private equity, they want everybody to be part of the future, that there will be an element of value that is dependent upon your future performance. And they want to see that element, that future performance, the value that's been generated is the people that are generating that value are the people that receive the benefit from that. So if you have a shareholder who wants to leave, some buyers will want to, a shareholder that is no longer in the business or wants to leave at the point of a transaction, a buyer will prefer for them to be bought out completely, cap the value that they can receive, and actually all the future value will go to all the other shareholders of the management team, whether they're incentivized or not. So even if you don't have an incentivized, and by the way, just to be clear, I'm talking about options here, EMI options, which is the most common way of incentivizing your management. If there isn't an option scheme in place, buyers will allocate value either consciously or subconsciously away from the deal and into those individuals that are imperative for continuing the business going forward. So there is a perception that it's the responsibility of the buyer to incentivize the team going forward. There is, but only beyond an earnout. The buyer will very much see that it's for the incumbent management to make sure that they are selling a business that's well-rounded, that is going to continue to grow, and that is all part of incentivizing the management team. That depth of talent beyond leadership. We've got a scalable management team, but what's beneath that? Are there people coming through that are really going to be rising stars and kind of continue the future of the business 5-10 years and beyond their point of acquisition? Retention record, I think, obviously speaks for itself. Make sure that you are able to keep your team. And people often talk a lot about culture and awards, and that's what makes them special. Buyers like to hear that, but actually they want to see what the kind of indications are of that actually within the business. And obviously strong retention is a very clear indication of the strength of your culture. And as are some awards, particularly around, the awards that resonate most for buyers are going to be the ones around things like DE&I, great place to work. They're the things that people, everybody likes to have the client wins and the client awards, but when we've talked to buyers, they go, yeah, it's lovely, but that's not really why I'm buying you. Actually, it's the people and the strength of your people and what they can do. And then contemporary response to macro factors. So B Corp, DE&I, these elements that are, ability to work with millennials. Weirdly, what are your responses to that? Being in the office and out the office is a very strong narrative and a big question for everybody at the moment. The big thing for you to think about if you want to sell to somebody, particularly if you want to sell to a strategic, is, well, how often are they in the office? So if you're going, I'm 100% remote, and you're going into an environment where that buyer has said, diktat, everyone's in 3 days a week because it's the only way we can build long-term value for the business. There's a culture clash that's not going to work. So you really need to think through there could be very powerful cultures, but actually it can limit where you're going to go. So are there steps and things you need to think about to change and get you in a stronger position to maximize the conversations that you can have? A real point of tension and an interesting one there. So that's looking at your management team, and then obviously what kind of sits alongside that is also going to be your systems and your processes. So this is about if you've got everything, the business looks really, really good. You've got great clients, you've got great offer, and you've got great people doing it. But actually, beneath that, it's all run off of Excel spreadsheets. You are going to limit your ability to continue to grow. And a buyer is looking for very robust practices because they've got robust practices. So you need to kind of face off against that and match. Not to the same level necessarily, but certainly you don't have to have enterprise level ERP, but you certainly need to have kind of some resource platform in there. You need to have some financial and commercial reporting in there, and the fact that you're at this seminar, I would hope that Mappers put you in a really strong place there. But there's always opportunity to do more. If you come across, we sold a business that was cash accounting before and didn't really do monthly management accounts, but it was super cool. And it was doing, and we had 4 or 5 buyers fighting over it, but the numbers were an absolute mess, and the deal almost fell over 3 or 4 times. We were having to go back and rebuild all the numbers. So, if you're in process and someone asks you for these X, Y, and Z information, and you can't, and it takes you a month to come up with that, doesn't look good. Like, that's how the experience is going to be on the other side, and they're doing monthly reporting that occurs within 7 or 8 days of the month end. You just lose credibility. Time is what kills deals. So I can't stress enough how important getting all of that. It doesn't have to be absolutely perfect, but just being in a good place will just make your life so much better. But then also you've got the sort of front office delivery, any delivery technology in the business is very, very helpful. So you might build bits of tech to help, deliver on client work. Documenting your approach, your ability to find, what is the more consultative your businesses are, the harder it is to scale, because you have to get very, very bright people that know exactly what you're doing. So what is your plan to be able to find and train talent? So this is kind of like systemizing a lot of what you do, so that, you've got something that looks pretty shiny and almost becomes just hygiene. It's almost taking problems away to make a deal, to make value creation much more easily. Cool. So there, again, I don't want to talk now that I like to talk about these things as kind of deal drivers and value drivers. And so the first four for me are very much about deal drivers, why people come to you and why they'll keep talking to you. And then, you've got the value drivers behind, them. And the two value drivers are profit and their growth. So, profit, it needs to be normalized. What do you mean by normalized, Joe? Well, if the business was owned by somebody else, what would that profit be? So very common for owner-managed businesses, you'll be taking a very efficient remuneration, perhaps a little bit of salary, a lot of dividends. Is I've often seen. You might have your spouse in there as employed. Kind of, you need to unwind all of that and put in a salary for yourself. So you have to think like an employee. Also, there might be some costs in there that you don't repeat. You might have non-execs that may not continue with you. You might have you made some investments that we can normalize. So there's a lot that we can do to look at your P&L in a very different light and present you in a fair, but also the best light. But you've got to be very careful here, particularly where you're taking bonus is another one. A lot of people don't have a pre-bonus profit. Obviously, this needs to be post-bonus. It's really important to kind of think about that. And bonuses, though they are always at discretionary, they become indoctrinated within people's minds. And so actually, I don't. The reality is that they are something the business has to continue to do. Now look at what's sustainable, how sustainable your profits are, how consistent you are. Perfect is 20% plus EBITDA, 15 plus is good. Buyers are looking for people that are more profitable than them, because you'll have less overhead and less sort of encumbrance. And scale is really important. So how does scale of your profit impact your ability to buy and sell, ability to be bought or to realize value in the business? Well, clearly, as I said earlier, is the multiple of your profit will determine your price. The biggest determinant of value is going to be the size of your profit, not the size of your multiple, because it's far more important in the equation. So you need to get that to a point that you can multiply it and get to a number that makes sense for you, or makes sense for you and the number of people in the room. Now there is it's got a sort of unwritten or written rule around sort of £1 million of profit being a kind of tipping point. Historically, I think that was correct. The reason why £1 million, you're basically getting into the opportunity where there's enough money to make things work for a seller, but more to the point, the deal value, the deal size is enough for a buyer to step in. Buyers, it costs a buyer £250,000 to buy a business. So you've got, you can't buy a business for £1 million if it's going to cost you £250,000. The return on the ROI for them just isn't there. So they need to have a business of a certain size and a certain ticket size. So somewhere between, if you're £1 million of profit, let's say deal size is 7 to 10 million, that's starting to get you in a place where buyers go, okay, I can put money on the table to do this and engage. What we've seen more recently is actually that level kind of increase. So a lot of buyers now are asking for businesses at £1.5 million or at 2 million. As their businesses have grown, for them to change the dial, they need to do bigger deals. They'll make exceptions for that, particularly where it's a very niche and specialized skill. That said, and I know, kind of a lot of the networks are doing that, like Accenture are doing that, kind of, so anybody that's made a lot of acquisitions, but there are always new buyers coming into the market that the 1 million price definitely still applies to. And I would say it is a tipping point where you get the most amount of buyers at that point. Beneath that, there's absolutely a market. Again, as I said, if you've got a very niche skill, something very contemporary, something very in demand, retail media would be a good example of that in today's market. Then yeah, businesses are eminently sellable, and we have sold businesses below £1 million of EBITDA. you just have fewer buyers. And if you're entering into that a process, you know, your options are likely to be less, your value is likely to be less, and you know, kind of maybe your chance of success is likely to be less. But you know, it's always horses for courses. The other determinant of value is going to be growth. So, you know, clearly, if you're at £500,000 EBITDA, but you're scaling incredibly rapidly, you can still get a very, very valuable deal. You know, I think we sold businesses at £500,000 EBITDA and had £20 million deals because of the nature of the growth, the overall the value that can be created, albeit that you've got to prove that growth. But everyone wants growth. Buyers are looking for growth when they buy you. They're looking for businesses that can grow themselves. They don't want to have to put the growth injection into them. And one of the biggest things we work on with people is their growth plan. It's you know, we can easily create a spreadsheet, but actually what underpins that, what are the pillars, specifically what within those pillars are you going to do, and you know, what are you doing, where have you had success, and how are you going to translate that into the kind of the future. So as I said, you know, we spend probably more time working with people before they go to market on this than perhaps anything else. So, you know, the growth has to be organic. Can't just have, you know, bought other companies. As you know, it's a good way of bolstering your business, but you've got to prove organic growth underneath it. You need minimum growth, you know, ideally 10% year-on-year growth for 3 years. Again, you know, there's probably a little bit liberal there, but you definitely need to have shown growth through the last, you know, number of years. I think nowadays a lot of people grew through 22 and are struggling in 23 or having slower growth in 23. So I think people do account for market conditions in this. Is your business scalable, structure and IP? And we touched on that a lot with management systems and so that's the management, and that's systems and processes. You know, do they support the growth, or is something going to break, or you're going to run out of steam at some point in time? And that last bit, the substantiated growth forecast, that's what I was saying. Forecast, that's what I was saying about actually the making sure that you can prove what you're going to do. So kind of they're the 6 building blocks of growth that we look at. This is whenever we do some buy side work for some of our larger clients. This is how I will break a business down into these 6 blocks when I'm analyzing it. It's how buyers will think about you when they're analyzing it. So it's worth just considering your business in the context of each one of these. I also, you know, a lot of the narrative there was about strategic clients, strategic buyers, sorry. This also has a lot of relevance to private equity, but they have a slightly different focus. So as I said before, you know, a strategic buyer will look at right offer and right clients, and that's what will be, you know, the most important thing for them to bring you to the door. Actually, private equity will start with, you know, are you of the right size, and actually they dictate that by profit. So private equity is you know, it's very, very structured industry. Different private equity funds will have different approaches and theses, but they will all have a minimum ticket size, so the minimum amount of money that they're willing to invest. Okay, now in the lower mid-market, which is kind of where we play, for a majority stake, people are looking around about 15 to 20 million to put into the size of the business. So therefore, you need to have a business with a profit of about $1.5 million, 2 million to be able to entertain private equity in that sense. Now, there are people that will do it slightly lower, and about $1 million to $1.5 million you can start to play, I would say. But actually, you know, kind of ideally, you're going to be in that bigger sector to have more options within the private equity arena. And you've got to have a really compelling growth story, because they're all about growth. Actually, what they want you to do, you know, every private equity fund wants to multiply their money 2 to 3 times. It will be built within their deal structures that kind of within a period of 3 to 5 years. So they need to know that you've got a growth. Now, there's a real difference between saying I can grow organically or I can grow through M&A. And if you can create a credible argument of growth through M&A, then you'll be regarded as a platform deal, and that's when you actually step the multiple up and step up the private equity houses that will be interested in you. So, you know, that's sort of really, really important to them. Then they're looking for management they can back, and the systems and so not system processes, just the management team that they can back. So, okay, how good is the business? Do I believe in the people? And then perversely, that's when they come back to the offer and the clients and the systems and processes. So yeah, they want the offer to be in an area that they're interested in, an area that they've done some research upon. It will be a high growth area. So coming back to kind of that growth. So all the building blocks are exactly the same. It's just the lens that people look at it is different depending upon how people are, the buyer that you're going through.
Joe, just to clarify, there's a question about the year-on-year growth.
Yeah, I just saw that.
Have you got that?
Yeah, absolutely, Sam. Thanks. So look, when I'm talking about year-on-year growth, is this profit or is it revenue? It's both. Quite frankly, the weirdly year-on-year profit, well, it's both. It's showing that you can move your top line and move your bottom line. Because sometimes it can be quite easy when you're small to build businesses that are incredibly profitable. Because you don't really have the systems and processes in place. You might have minimal back office function because of the way you managed to build it. So actually, there's always a risk for businesses that we see that are too profitable. So sort of I'd say getting to 30% plus. Actually, the only way of growing that business going forward is going to be actually diluting the margin. So you'll see that whilst you could grow that business with revenue growth, actually it's going to be a struggle to grow their EBITDA, and it probably might even go down as you're trying to scale it. So it's definitely looking for the ability to continue to grow both.
Yeah, well, the private equity piece, obviously, you explained it there from private equity's perspective, but from our client's perspective, the seller, vendor, whatever you want to call them, could you just explain a little bit and help them to understand what private equity would look like for their business as opposed to a sale?
Yeah, look, absolutely. So, in fact, a lot of the processes that we run at them. So, private equity has become a huge part of our industry. So we're running processes now that will be dual processes. So we'll go to private equity as well as we will go to trade buyers, just because they're so prevalent and there's a lot of opportunity there. It is a very different prospect. If you're selling to a strategic, the biggest difference is selling to a strategic. It's the end of your journey. So you are, ultimately it will provide you an opportunity to exit the business. As I said here, for private equity, management is really important. So they're looking at who they're buying, who are the management team that they're backing. But for most people, it will be a step in the journey of the business before an exit at some point in the future. The only exception there, which is in both instances, to be honest, is if you've got a founder that's no longer involved in the business at all, then you can buy them out. Both situations will allow them to buy out and de-risk. But if you're a continuing management shareholder, private equity is just a step. Typically a deal structure will be, they want someone to be a buyer and a seller. So they want you to sell 50% and keep 50%. Now you can structure that such that you might sell a little bit more, but you end up with kind of 50% of the equity going forward. So your value creation opportunity in the short term is going to be lower, albeit the upfront value might be about the same, or potentially even better. But you've got to continue to grow the business. You've got to have a growth plan that outpaces, as I said, the market. You've got to be able to grow it 2 to 3 times. It's a lot of the private equity structures will be pseudo debt. So actually they will put the money into the business in terms of what they call preference shares. They're basically debt in the business. They have a coupon of about 10 to 12%. So and that rolls up, rather than having to pay it down. But you've got this sort of this lump of debt that you're gonna have to pay down first upon exit. That means that your slice will only be the element above it. So for a lot of people, and the reason why when we run dual track processes, people generally end up with a strategic buyer is that when they look around at all these details, it doesn't feel very appealing. What it does give you, and why people do it, is where they are. Their ambition is M&A, and their ambition is to scale the business aggressively, and they want to remain independent. They want to keep their brand. They want to keep their independence. They want to remain CEO of the business. We have both exceedingly good reasons to kind of do it. So and there are some very, very good private equity backers out there. The bigger and more desirable your business is, the better you can structure the deal. So yeah, look, they are different journeys, but the hybrid is that a lot of the deals we're doing are private equity backed businesses, where you still get the sort of 50% roll into equity, 50% in cash up front, but you don't get the debt and kind of the other structures aren't there. It's more about just going on the journey, and people get very comfortable with that.
got a good example actually, and we did interview John from Space 48 on a podcast, and he talks about this, and he was sort of considering his options at the time, but you worded it really well. He wasn't ready for the end of the road. He was enjoying it, and he saw it as a career opportunity to basically be, growing and building a bigger business with more smart people and more money around him. So he took that as an opportunity to de-risk to a degree. So he got some cash off the table, but he's still part of that journey, and he's now part of a bigger, faster growing business where he's still the CEO, he's still a leader, but he's growing through M&A. So it's, you could almost say in a way, best of both worlds. He's de-risked, got cash off the table, but he's still on that journey, and he's still as hungry as ever to grow the business.
And look, and if you grow the business successfully, your opportunity to create value is far greater, right? Because you can keep, you're getting 2 to 3 times as well as them as well as the private equity backer, and I would say that you have more options in this space than you've ever had before. So hence why it's pretty interesting, and we're not seeing it slow down at all as a result of changing interest rates, and they just restructure it slightly. So look, I've just sort of got another sort of 5 minutes perhaps, and if there's any questions, but I've got 2 more slides. One is, where has value come from in 2023? So I put a couple of charts on that we just did a bit of research early in the year I thought might be interesting. So the chart at the top left is, deal volume from the buyer set. Our buyer set is your buyer set, is pretty much the sort of people that you can see there. And it just sort of plots their kind of deal activity over the last sort of 3 years. And everyone has said sort of 2023 was the death of M&A. If you read the Financial Times or any of the headlines, that no one's doing any deals. And the reality is it's only 20% down year on year, which to me doesn't feel like a lot. And that's compared to 2021 and compared to 2022. So you're not seeing the decrease we saw in Q2 2020 because of the pandemic. So actually, deal markets has been pretty good and alive. This year, demand has outstripped supply, so there's a lot of active buyers. There has been a change in the people that are buying. So looking at the chart at the bottom, so you've got private equity, PE-backed, technology consulting, so that's the likes of Accenture and their contemporaries, management consultancies, so the likes of McKinsey and their contemporaries, and then you've got marketing communications that are the businesses that you'd expect. And you'll see that the technology consultancies are this year have spent far less. If you look at their share prices, you'll see why. Digital transformation has been really difficult year for everybody, particularly in the UK, but kind of globally. There's been a sort of readjustment on digital transformation. But marketing communications businesses have stepped into the market and are buying and are pretty active at the moment. Now that's obviously the whole cause is there looking at strategics that a lot of people are mixed opinions on them. Some of them are better buyers than others, but they do some good deals. Omnicom did a huge deal over the summer and are out buying more and more, weirdly. They've got a very unique strategy in the way they're doing it, but after being quiet for a while, they're back in the market. We've got sort of what I call mid-cos, so the likes of Next 15 and that sort of cohort, MC Saatchi, that aren't the big listed businesses, but again, very, very buyers, very sensitive buyers operating M&A strategies for many, many years. Then you've got newcos, that would have been S4 Capital, where he is now, but people like Stagwell, they've got private equity backing that are quite established players, but are slightly newer in market, trying to create new models out there and quite dynamic and good people to sell to. Then there's emerging buyers, and this is probably the largest sort of sector. Many of these will be private equity backed, so crossing over into that financial, and that's, like I say, is where we're seeing a lot of our market. So it could be the likes of Brain Labs, it could be the likes of Crowd. We sold a business that was backed by TPG. There's debt that's backed by Carlyle. These are still, they're on M&A journeys, and so they have to buy. It's almost sort of raison d'etre for them to be able to grow and fulfill the brief. So they continue to be in market, they continue to buy, and the private equity guys don't really, they don't have a share price to be sensitive to, and the private equity guys don't care about market trends. They're like, there's a ticking clock here. We need to keep being active. So there's definitely things that are going on. The consultants are a little bit quieter at the moment. They're going through their own sort of challenges. but they still need to contemporize their offer, all right, and remain relevant. And then private equity backed, and growth capital. We touched on it a bit on the last slide. So, you know, difference between private equity and growth capital is a majority versus a minority in most instances. Growth capital is about money into the business. Private equity, you know, money in and money out typically. But you know, as Paul said right at the top, that's not the only option for value. Obviously, kind of selling to your management team, MBO and EOT, or just running for profit. And kind of like the 6 building blocks of value, as Paul alluded to as well, they're relevant to just, you know, building a good business that you can run for profit. And finally, just kind of what's hot. So what are we seeing people really ask for in 2023? Performance marketing remains very in demand. Social media, PR influencer. I put content in there as well. Digital content, native digital content. Retail media. If that's a term you've not come across before, it used to be sort of Amazon marketing. That's now sort of the, you know, kind of just retail companies have a lot of media and, you know, selling through Tesco, Walmart, Amazon, etc. So just, you know, being able to operate within inside other people's platforms. You know, the client sectors, technology, healthcare, finance, sport, I touched on. B2B had been a really big area, mainly because B2B was growing more quickly than other sectors. It's a bit quiet at the moment, but I think that's going to come back, and that's mainly because of their exposure to technology businesses. But yeah, it's still very desirable as a kind of a discipline. Specialist technologies, so enterprise tech implementation, mid-tech, you know, anyone that's doing Salesforce, SAP, you know, Adobe. So all that marketing technology is very, very desirable. Some of the specialist technologies like ServiceNow. So, you know, people are cloud computing. There's definitely a lot of desire for those specialist skills that people are wanting to buy and bring in. And then obviously AI and ML, automation is important. And then, you know, just so anybody that's producing strategic advice, C-suite, influencing the business.
You mentioned digital transformation on the last slide, as you, I think having challenges and having to change things. Can you just elaborate on that a little bit more?
Yeah, it's just you know, so sort of the digital transformation, digital experience space, you know, grew phenomenally through the impact the pandemic as the world moved online, and every business couldn't not have a digital strategy apart from Primark. So, you know, there's a huge amount of investment that went into that space, and I would argue, you know, or kind of retrospectively looking back, probably overinvested in that space. And as the world has gone back to normal, if we know what normal is, then people realize that they don't, and people have struggled in their trading as well. So it's been a difficult year for a lot of people. There's not the investment in those budgets that there was by clients previously. Either people have bought, or they're just not investing as much because their businesses isn't in the same place. So there hasn't been the RFPs in digital transformation and digital experience over the last 12 months that there was in the previous 12 months. So we are seeing definitely a lot of people not growing at the pace that they want to. And plus, there's been a lot of challenges. You know, there was wage inflation, just inflation more generally has put pressure on businesses. So if you couple your cost base increasing and struggling to grow at your top line, I think it's been a difficult year for 2023. I don't think it's terminal for digital transformation, digital experience. I just think it is, you know, just a realignment in the marketplace.
Yeah, that makes sense. Thank you.
Cool. And that's me done. I don't know if there is any questions. I've left 5 minutes at the end.
Yeah, there's none waiting at the moment, but if anybody, as I say, just to reiterate, raise your hand, pop it in the Q&A, pop it privately to me or Joe in the chat. Either way is absolutely fine. Again, appreciate the sensitivity of some of this, so we can answer questions on a no names basis if you wanted to direct message me or Joe, and we can read it out without mentioning your name. That's absolutely fine. We have recorded this. It says recording at the top, so let's cross our fingers. So I'll get the recording out later today in the WhatsApp group and over email as well, along with the slides. So questions here, I'm just checking carefully. It says host and panelists. So I think if we just avoid names, just to maintain.
Yeah, I won't make any names, but So, it's a really good question about what happens to, if I want to exit immediately without an earnout. So, the biggest impact it has is on the amount of value that can be created, because there's, it's all about the risk profile in the deal. If you're cashing out everything up front and not, the whole point of an earnout is to prove the business is what the business said it was going to do. And therefore they're like, well, I'll pay you more if you said you were going to grow at 25% a year, well then fine, I can pay you for that. If you're just buying a business today and somebody is leaving, and by the way, then you can never create as much value as you would if you're willing to hang around for an earnout and have an earnout structure. If that person was instrumental to the business, or just even working, if it was a founder working full-time in the business and they want to leave at the point of sale, then that creates even more risk in a deal, because you're removing that position. I would say 9 times out of 10, the founder's main job is new business and growth of the business and strategy. So actually that creates a lot more risk for a buyer. So again, it just plays to value and your ability to kind of get it away. How do you manage that? You have to remove yourself entirely from the business for about a year before you sell, and you have to realign the shareholder base, because you're going to have to put more hands in value in the hands of the people that are going forward. So it's harder. I'm not going to lie to achieve that, but not impossible.
Probably a little bit about get the narrative straight as well. Like for the buyer, why is this person wanting to jump ship very suddenly?
I think so. It's more about just the shape of the business and the people within it. Like if you've got a genuine entrepreneurial, CEO in the business, and the founders can actually step away, and you've got scale in the business. Scale is really important, because actually then the business, it's just more proof points that the founder generally is out the business. But even when you come to structure the deal, if the founder's not going with it, it's always just harder to create the same amount of value. But there might be enough value for people. There's a question here. So in terms of what if you're looking to sell, I think the question is, what sort of businesses might be able to sell without having to scale in the same way. It's quite hard to answer that. Like I say, the retail media is probably the one at the moment that people are saying I would be willing to kind of come down a bit. Anything that's got any bit that's got a contemporary piece of technology in a handful of really, really good clients, I think is the crux here. So it's the balance of the technology and the clients that means that somebody is willing to step in, and you've kind of got the maturity in that small business of a larger business, or the fame of it, to allow you to kind of to be able to sell. Like I say, all businesses can be sold. It's just you change your options and your chance of success. And then is EMI the best option for manager incentives? In my opinion, yes. You have to be very careful about how you put them in. You'll be really sensitive to the value that you want to. Well, you've got the hard thing about EMI is getting people to value the scheme. So how do you make it? How do you make the scheme make a difference to their behavior in terms of their desire to work in the business and the desire to not leave, and their motivation to work within the business? And so actually an EMI scheme in itself is the right mechanism, but only when it's delivered in the right way. So you've got to sell a dream and a sort of wider, kind of a wider story, a narrative around it to get it to work. You spend quite a lot of time with clients helping them through that.
Yeah, certainly from a tax perspective, it's very attractive. But as Joe says, it's typically tied to an exit. So the people that are going to get those share options need to believe that there's a realistic chance of an exit, and that they can contribute towards that.
Yeah.
Nathan's asked one in the Q&A about EOTs. I don't know if that's something that you're comfortable.
Yeah, no, absolutely. No, we've done EOTs. We've put in EOTs. I've sold EOTs. They are they're so for anyone that doesn't know about EOTs, is employee ownership trust. Effectively, it allows a founder to sell their shares to the business without 0% tax. They've been used and abused very well in the past, with people putting very high valuations on and not really selling the business. The government's getting a little bit wise to that. They work really well where there's a genuine change within the organization and you sell 100% of your shares. Very, very effective. They're very tax efficient putting them in. They're very, very tax inefficient putting them out. So if the people incoming into the organization want to buy the business, sell the business down the future, they just need to be really conscious about what they want to do and what it really does mean for them. But yeah, definitely we see it a lot with people that either don't want to sell or can't sell their business for whatever reason at that point in time. It's a good way to de-risk.
Great, super. I think we're all done. Just give a few more seconds in case anyone has one last burning question. But obviously to say that you can have my contact details and Joe's contact details over the email as well, so feel free to reach out direct. Is email the best way, Joe?
Yeah, please. Yeah, absolutely. Or LinkedIn, whatever people are happy doing. But yeah, very happy to connect and have a conversation with anyone that's feel that'd be helpful.
Yeah. We'll share a link to your LinkedIn profile as well as your email address, your slides and the video later today. So super. I think we're all done. Thank you very much, Joe. Really appreciate your time today.
Thanks, everyone. Thanks for listening. Thanks, Paul, for hosting. And I'll speak to you soon.
See you soon. Bye.
Bye.